Knockouts and call spreads, the basics. Let's learn about the basics of knockouts and call spreads. And again, I do need to share the disclaimer that trading involves risk and may not be appropriate for everyone, that any trading decisions you make are solely your responsibility and at your own risk, and that, again, this is an educational session. Please do not construe anything I say as a buy or sell recommendation. All right, so what is the agenda here for knockouts and call spreads? I've already gone over who is Nadex. I covered that in the very first session. If you're joining us late and want to know more about Nadex, I would recommend you watch the recording of the very first session where I introduce Nadex and our contracts designed specifically for retail traders, people who want to access price action in the markets but don't have thousands and thousands of dollars. They can do so with hundreds of dollars, although you can obviously access our markets with thousands as well. But what's really cool is our products all have defined risk, defined reward, so that there are no surprises. In this particular session, I am going to cover what are knockouts. I'm going to define them for you, and then we're going to talk about how they work. I personally think knockouts are the most intuitive contract that we've got, because it's a delta one. And again, I'm throwing out a buzzword, but you'll understand what a delta one product is at the end of the session. We're going to talk about risk, reward, and the capital requirements. And then I'm going to go into call spreads. I do knockouts first because I think once you understand knockouts, call spreads and understanding call spreads is a layup. It's very easy to understand call spreads once you understand knockouts. And as I mentioned before, we will do a practical demonstration. I will jump over to the platform and you will be able to take a look at knockouts and call spreads and identify them very clearly on the charts and understand what it is that you're actually trading. We've got some great visual cues on our charts so that you can clearly understand knockouts and call spreads when you're looking at your chart. Okay, what are knockouts? A knockout is a contract and it trades within a predetermined set range. Okay, and that range has two price levels. There's a floor, which is the lower price level, and there's a ceiling, which is the higher price level. Okay, and the contract will trade in line with the underlying market between the floor and the ceiling. So when I say it's a delta one contract or a delta one product, that is what I mean. It will move the price of a knockout will trade directly in line with the underlying market. So I am going to use gold as an example again. If gold were trading at $17.20 per ounce, the price of the knockout would be $17.20. It is what you are used to when you trade any stock. A stock is a delta one product as well. It's unlike a binary option where you're trading a probability. Right? A binary option is a probability. There's a 40% chance it's going to be true. There's an 80% chance it's going to be true. There's a 50-50 chance it's going to be true or false. A knockout, you are trading the price of the underlying period. So if you thought gold were going to go higher, you would buy it. If you thought gold were going to go lower, you would sell it. Now, that is actually confusing to some people because they'll say, how can I sell something that I don't own? And this is a contract. All right, so it's not the actual physical product that you're trading. You're trading a contract that represents the price of the underlying. So if I think gold were going to go lower, I can take a bearish position by selling a knockout. I am predicting that the price of gold were going to go lower. If I thought the price of gold were going to go higher, I could buy it. So you can buy or sell a knockout, and what you're trading is the actual price of the underlying. Okay? Very intuitive, very straightforward. Now, So that's what a knockout is. It's going to trade right in line with the underlying, and it's going to have a predefined range. It's going to have a floor, a price at the below, and it's going to have a ceiling, a price above. I think that's pretty intuitive and pretty straightforward. Hopefully you understand that, because now, how does a knockout work? Now, a knockout, it's a contract, and it will expire or settle in one of two ways. There's a price triggered settlement and there's a time triggered settlement. Let's first talk about a price triggered settlement. So we've got a Nadex, we've got a knockout, a Nadex knockout. And again, I'm going to use gold because I think it's just super easy to understand. I think I'm buying or selling the price of gold. So it's trading at 1720. I buy it if I think it's going higher. I sell it if I think it's going lower. And if the underlying market for that product touches the floor or the ceiling, the contract settles. It's price triggered settlement. And essentially, the reason it's called a knockout is if it touches the floor or it touches the ceiling, you are knocked out of the trade. That is why it's called a knockout. If I buy a Nadex knockout, I think the price of something is going to go higher, but it goes lower and it touches the floor, I would get knocked out of the contract and I would experience maximum potential loss. So I buy it, I think it's going higher, instead it went lower, touched the floor, I'm knocked out for maximum potential loss. If I buy it and it goes higher and it touches the ceiling, all it has to do is touch that price, I get knocked out of the trade and I would experience maximum potential profit. So if I buy a knockout and it touches the ceiling, I'm knocked out for maximum potential profit. If I buy a knockout and it goes down and touches the floor, I am knocked out for maximum potential loss. It also works the other way. I can take a bearish position. I think gold is going to go lower. I sell the price of gold. Now, if I am correct and the price of gold goes down and it touches the floor, I am knocked out of the trade and I experience maximum potential profit. I sold it, it went down to the floor, touched the floor, I'm knocked out, the contract settles and it's over and I get maximum potential profit. If I sell it and it were to go higher and touch the ceiling, I would get knocked out and experience maximum potential loss. That is the price triggering. So a knockout, delta one, I am buying or selling the price of the underlying, and the price of the knockout will move directly in line with the price of the underlying, but it's trading in a predefined range. I've got a ceiling and a floor going into the trade. I know exactly what my maximum potential profit, what my maximum potential loss are, and if it touches either one of those, I get knocked out of the trade and I move on to the next trade. Now, it's possible that a knockout did not touch the floor or the ceiling. It trades between the floor or the ceiling. Eventually, there will be an expiration time that contract will settle. All right, that would be time triggered expiration. And if that were to occur, my profit or loss on my trade would be the difference between where I bought or sold it and where it settled. So if I bought a knockout and it went higher but did not touch the ceiling, but it gets triggered by time, I would experience a partial profit. I bought it, it went higher. I never got knocked out. It never touched the ceiling, so I never got knocked out, but it did finally come to expiration. It settles. It's higher from where I bought it. I have a partial profit. If I buy it and it goes down but doesn't touch the floor, I lost money, so I'm going to experience a loss. I won't experience maximum loss unless it touches the floor. It touches the floor, I'm knocked out of the trade for maximum potential loss. But if I were to buy it and it were to go down, I would have some type of partial loss if it came to expiration settlement without touching the floor. And it works the other way if I sell it. I sell it and it goes down but doesn't touch the floor, I have a partial profit. I sell it, it goes up, it doesn't touch the ceiling, I have a partial loss. So that is how a knockout works. It's got a predefined range, and those boundaries are hard knockouts. It touches either one of those, the contract settles. Now let's talk about how these work. When we list our knockout contracts, they have a duration of a week. All right. And we'll start each knockout contract. There'll be 4 different knockout ranges for each product. And I'm going to walk through that as well. And there's a reason why we provide 4 different choices when we start. Now, what's going to happen is as the week goes on, the knockout will probably touch a floor or a ceiling. That contract settles, it's gone, and we then list a new contract so that there is generally always 4 available. If it touches a floor or ceiling, it gets knocked out. That contract settles, it expires, it's gone. Then we list another one, a new range, so that you've always got 4 choices. And generally, there will always be 4 choices. Not always, but generally there will always be 4 choices for you to choose from in most market conditions. And again, I will get to why we offer a variety of choices. Now let's walk through an example so you can actually see it. All right, this is an example of the S&P 500. And here we are on the left-hand side. This is a chart, and the chart will populate. We're starting the week, and again, arbitrary numbers. The S&P is at 2720. All right, and we list 4 knockouts: 1, 2, 3, and 4. So you'll have 4 different knockouts. Now, the way that we do the S&P 500 is there's always a 50-point range between the floor and the ceiling. It is not always 50 points. In Nasdaq, it's 60. So there's a different range for each product, but you'll get that in the product specs. I don't need to get into the weeds too far on that. But for the S&P 500, the way that we do it is we know it's starting at 2720, and we'll create a floor and a ceiling. For knockout number 1, the floor is 10 points lower, and the ceiling is 40 points higher. So we've got a range of 50 points. And then we'll do knockout number 2, where we'll start 20 points lower and 30 points higher. So again, you've got a range of 50 points. It's just that your floor and ceiling are at different levels. And then the 4th knockout, we actually move the floor all the way down 40 and make the ceiling only up 10. So you've got a variety of choices. There are 4 different knockouts. Now, what happens? And here's the price of the S&P 500. It's trading. We've launched 4 knockouts. And let's go through a price-triggered settlement. And you can see the red line at the end of the week is where expiration would be on a time-triggered settlement. So first, we've launched we've got 4 contracts, and the S&P starts trading up a little bit. As it goes higher, you'll notice that it hit the ceiling of knockout number 4. All right, it started trading higher. Knockout number 4 ceiling was only up 10 points. It hit that ceiling, and that contract settles. It expires. It's knocked out. That contract doesn't exist now. So anyone who had bought would be knocked out for a profit because it went up. Anyone who had sold would be knocked out for a loss because it went up and it hit the ceiling. And then because it went higher, we list a new knockout that is higher because the price of the S&P is now higher, so that we would constantly have 4 knockouts available. Let's go through an example if it were to go lower. So here's the same situation. We've got those 4 different knockouts. And notice that the floor on knockout number 1 is only down 10 points. And here we look at the S&P 500, and it starts trading lower. And of course, since that's the highest floor, knockout number 1, we just touched the bottom floor. It's knocked out. Anyone who bought knockout number 1, you bought the price level, it went down, it hit the floor, Anyone who bought got knocked out for maximum potential loss. If someone happened to have sold that contract and it went down, they would have gotten knocked out for maximum potential profit. That knockout's now gone, and because the S&P went lower, we add a new knockout down below. Seems pretty straightforward. We keep 4 knockouts available, and as knockouts are settled or knocked out because either the floor or the ceiling is touched, we list that gets knocked out. Anyone who traded that knockout settles up, and when we launch a new contract. Now let's take a look at time triggered settlement. All right, it doesn't touch the floor or the ceiling. And I kind of talked about this earlier, is your profit or loss on a knockout with a time triggered settlement would simply be the difference between where you bought or sold it and where it ultimately settled at the expiration time. So if we look at this, here's that S&P 500 example again. Now we're late in the week. All right, it's the end of the week, and we had these 4 knockouts listed. And as time went on, look at knockout number 4. Eventually, it trades, it settles. That's it. It's done. And the profit or loss on any of these knockouts would be the difference between where you bought or sold it and where it ultimately settled. Right? Which is, again, as a Delta One product, if it's like any other product. If you bought it and it went lower, you lose money. If you sold it and went lower, you would make a little bit of money, and then vice versa. If you bought it and it went higher, you would have some type of partial profit. And if you bought it and it went lower, you'd have partial loss. All right, so that is how knockouts work. Okay, pretty straightforward. You've got a Delta One product. It's got a range that it trades in. It's a predetermined range. And if it touches either one, the floor or the ceiling, you're knocked out. This is a way for people to take a directional play on the price of an underlying asset and have some clear, distinct boundaries around it. So let's talk about that risk and reward. We know what your maximum risk or reward is before you enter a trade. If you buy, if you buy it, it could go up to the ceiling and make maximum profit. You buy it and it goes down, touches the floor, you're experiencing maximum potential loss. What we've done with knockouts, and the reason we created knockouts, is for the retail trader. All right, a lot of retail traders have a difficult time establishing parameters around their trade where you would have natural exit points. All right, natural exit points. Now, what are natural exit points? The very structure of a knockout, it's got 2 points for you, whether you're buying or whether you're selling it. All right, which is sort of like a trading plan baked into the product. When you buy something, you should have an idea where you would exit for a profit. Right? You should have an idea. If I were to buy this and it were to go up, where would I sell it, take my profit, and say thank you very much? You should also have a stop loss level. Dan was talking about that earlier, is managing that risk. How do you manage that risk? And how do successful traders often, why are they successful, is because they minimize their losses. They are really good at managing losses when they're wrong. A knockout has a predefined stop loss in it as well. So, and this is ultimately why we offer 4 different levels. It's so that you can customize your trade, so you can manage your risk reward profile how you see fit. But essentially, that's what a knockout does. It's a built-in, baked-in trading plan for every trade. If I buy it, I know I've got a floor where I will get knocked out for a stop loss. All right, I bought it, it goes down here, I want to get out, and there is no slippage, there's no sending another order. You buy it, it touches that floor, you're knocked out. So you choose a knockout range where you're comfortable with that risk. If you bought it and it were to go down, or if you sold it and it were to go up. Okay, so you've got that stop loss level baked in, and you've got a profit target on the other end of it as well. It sort of forces you to be disciplined if you're having a difficult time disciplining yourself and taking your losses when you should and taking your profits when you should. So it's baked into, it's the inherent nature of the product. I think I've covered this pretty well. I'm going to leave this slide in here if you were to go back and take these slide decks and you wanted to review this, but for the sake of time, it's pretty intuitive. I think I've covered this pretty well. And the cool thing is, on our platform, you'll see your potential profit and your potential maximum potential profit, maximum potential loss calculated for you on the order ticket. It's all given to you right up front. You don't need to do any of the math. We'll show you. You click on a knockout. Where's the ceiling? Where's the floor? Where's the product currently trading? Here's your potential risk. Here's your potential reward. Now, I do like to also go through an example of buying and selling with a slightly different visual to it, because this is also something when you're looking for choosing which knockout you're comfortable with, it's identifying the risk reward ratio. So here is that example of the S&P 500, and you're looking to buy one. If you were to buy one, what people will generally do is you'll look for one where the floor is close. So it's keeping your stop loss tight. All right. I'm not telling you that you have to do that. It's what many people will do, is if they're buying, they'll tend to choose one where the floor is close. Now, if it's too close because you're afraid it might just trade down and knock me out and then go higher, maybe you'll choose knockout number 2. That is determining that risk reward profile that you're comfortable with. So let's just take a look at knockout number 1. If I were to buy knockout number 1 and put it in a nice visual little chart, here's where it is now, is on the left is the black line. Expiration is on the right. That's the settlement if it doesn't touch the floor or ceiling. I know the floor, all right? I know the ceiling, and I know the current price. So if I wanted to visualize what my risk versus reward ratio were, if I were to buy this and it went down, this is what I stand. The red area down below is what I stand to potentially lose, and the green area is what I stand to potentially make. You've got to determine where your risk reward comfort zone is. If you're comfortable with a little bit more risk and you don't want to be too close to the floor and get accidentally knocked out, and you were to choose, say, knockout number 2, the red zone would be a little bit larger and the green zone would be a little bit smaller, and you could look at your risk reward ratio. How much am I risking? How much am I potentially making? Assuming maximum potential profit or loss. That is why we offer 4 knockouts. It's for you to be able to customize your trade with the amount of risk that you're comfortable with the amount of reward that you would like to get for taking that risk. And again, those boundaries are hard boundaries. If I buy and it touches that floor, I'm knocked out. If I buy and I can't lose anymore, it can keep going lower, 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 lower. I can't lose anymore. If I buy and it touches the ceiling, I am knocked out. I get my green. But if it were to go higher and just keep going higher, I couldn't make anymore. My profits are capped. My risk is defined. My profits are capped. Defined risk reward. That is part of what Nadex offers. That is all of our contracts. That is why we are for the retail trader. This is something that forces you into being a little bit more disciplined, where it's going to give you firm, hard knockout levels if you're wrong. Let's go through the same type of example, except instead of buying one, you're selling one. And I think the S&P 500, we're going to go lower, all right? And I'm just trading the price of the S&P 500. So I sell a knockout at 27.20. Now, if I'm selling it, I might look for a knockout where the ceiling is the closest. All right. Again, because if I'm wrong, I sell it and it goes higher, I want to get stopped out. I want to manage my risk. I want to control my risk. If the ceiling were a little too close, you felt you were playing with fire, you might choose knockout number 3 to give you a little bit more wiggle room. But let's go through that same little chart. If I sell the S&P 500, I'm taking a bearish position. I'm looking to profit if it goes down. All right. I know where I am now in time. I know when settlement is. I know where my floor and ceiling are. If I sold this knockout and it went up, that is my risk. The red area, that's what the most I could lose. If I sold this and it went higher and higher and higher, I couldn't lose any more than once it touches the ceiling, I'm knocked out for maximum potential loss. And down below, I've got a profit goal below, right? I sold it. I'm looking to profit if the price goes down. I've got an exit. Now, if it touches 2680, I am knocked out for a maximum potential profit. I sold it, it went down. And if it kept going lower, I couldn't make any more money. But this is how you manage your risk reward ratio. How much risk am I prepared to take? What am I looking for potential profits? Knockouts have clearly defined ranges. You choose which range suits you the best. And when I jump over to the platform, it becomes abundantly clear and very easy to identify what your potential risk reward are on any knockout. And again, we calculate it for you on the order ticket. All right, now capital requirements. Because you know what your maximum risk is, that's what you're going to have to put up, the most that you can lose. So it's a way for you to take a trade and if you choose the smallest amount of risk, you can actually trade a knockout with small quantities of money. It's whatever you could potentially lose on the trade is what you need to initially put up, and that will never change. Once you get into a trade, you can't lose any more than you initially put into the trade. That is something at Nadex. You get into a trade, you know exactly what you could potentially make, you know exactly what you could potentially lose, and you put up the most that you could potentially lose. That doesn't change, and it doesn't matter whether you're buying or selling. Your risk is a known commodity, it's a known quantity, and that's what you have to put up in order to trade a knockout. And again, the reason why we gave so many knockout levels is so that you could minimize your capital requirements. I'm going to choose a knockout with the least amount of risk. So if I buy one, I want one with a very close floor. If I sell one, I want one with a very close ceiling. You can manage your risk. You can minimize the amount of money that you need to put up or trade a knockout or take a bullish or bearish position on something, an equity index, a commodity, a foreign exchange pair. You choose the knockout with the least amount of risk. That's the one you would also need the least amount of capital or money to put the position on. Now let's take a look at order ticket for a knockout. Similar to the order ticket for a binary, in as much as there is an indicative price on there. And then at the top, it's going to give you the range. The range, and this is for the NASDAQ, and it gives you the floor, 13,052. It gives you the ceiling, 13,202. Notice that this has got a NASDAQ knockout, a one lot is worth a total of $600. Okay, and you can see that from the bottom of the order ticket versus a knockout for an S&P, the total is 500. Now, there will be a bid and an ask. Remember, I don't have to trade on those prices. I could choose to put a bid or an offer in between. So like here, I'm trying to buy one for $13,073.50. Notice, and I did want to point this out, notice the indicative price is $13,074. And notice the bid-ask spread, 13,072 and a quarter, 13,074 and 3/4, or 75. The indicative price, the price of the binary, the bid and the ask on the knockout, it's right around the indicative price. It's straightforward. You're trading the underlying price, and the bid and the ask are generally going to be right around the the current indicative price. And if I were to buy one or sell one, it's going to give you your maximum potential loss and your maximum potential profit on the order ticket. There's no you having to do any math. We would give it to you for you. We would put that on there for you. If you're initiating a position, before you even get into the trade, you would know what you could potentially make and what you could potentially lose, and you can adjust and choose which knockout suits you and what price you might want to potentially trade it at. And again, it's a central limit order book. I can try to put an order between the bid-ask spread, or I can put a bid below the market or an offer above the market. Now, call spreads, and this will only take a couple of minutes, because if you understand knockouts, call spreads are pretty straightforward and intuitive. Call spread also trades in it's going to have a predefined range. Doesn't trade in it has a predefined range. It will have a floor and a ceiling, and it will be very, very similar to a knockout. All right. But I say similar to a knockout. It is not the same as a knockout. And there are two reasons why a call spread is different than a knockout. All right. The two ways a call spread differs from a knockout. Number one, a call spread only expires at expiration. It only has a time triggered settlement. There is no price triggered settlement. So even though I've got a range on a call spread, it does not knock me out if it touches the floor or the ceiling. Let me repeat that. It does not knock you out. That is the difference. A knockout is a knockout. It touches the floor or ceiling, you are knocked out. A call spread can trade through the floor or ceiling and continue to move, because a call spread has that optionality. Right, it's going to have a slightly different pricing mechanism. That volatility, the price of a call spread is going to incorporate volatility in time to expiration. It is not a delta one product. All right, it's not going to move exactly in line. It will not be priced exactly in line with the underlying. It's going to have a premium in it. And the reason it has a premium in it is because it has that optionality. If I were to buy a call spread and it were to go down, I would not, if it touched the floor, I'm not knocked out. It gives me more time to potentially be right. I buy it, it touches the floor, and then it comes back, I could still make a profit on the trade. Now, realize, again, my risk is a known commodity. When I buy it, I can't lose any more than what I paid for it. So if I buy it and it goes down, it touches the floor, I'm still not knocked out. I got to touch. It keeps going lower and lower and lower and lower. I can't lose any more than I put into the trade. I knew that up front. Right. Now, it also works if I buy it and it goes up through the ceiling, I'm not knocked out for a profit. I'm not forced out of the trade. It can go all the way up. I could be making a profit on the trade, and if I'm not paying attention, it can come all the way back down and it could turn into a loss. So you need to exit a call spread before to get out of the trade, or it'll settle at expiration. So if you want out of a call spread, you have to, if you bought it, you'd have to sell it. If you sold it, you'd have to buy it. You're not knocked out at your boundaries. Okay, that is how a call spread differs. Now, I want to look at a call spread order ticket, because I mentioned there's a premium, and it's important to understand what I'm talking about. Here, you see the indicative price of the Nasdaq. It's 13,070. 13,070. It gives me the range of the call spread. Okay, so it's right at the bottom level of the range, 1370 to 13,170. Notice that the price, if I wanted to buy this, now a knockout would be trading 13,070. I'd have a knockout price right around that. Notice that the price for this call spread, it's well above 13,070. It's trading 13,108 bid at 13,114. Let's just make it 13,110. 13,001. That's 40 points higher. There's 40 points of premium in the call spread. That is because there is almost 22 hours to go. This call spread has 22 hours to go. That is that 40 points in premium that you would have to experience if you're trading this particular one, because it has that optionality baked into it. Now, if I were to buy one at 13,112, I'm trying to buy one in between the markets, it does clearly tell me what my maximum potential profit and what my maximum potential loss are. Okay, so on the call spreads and on the knockouts, we do calculate what your maximum potential profit are and maximum potential loss are on the order ticket, whether you're buying or selling. And the big difference between knockouts and call spreads, a knockout, it's a price triggered settlement or a time triggered settlement, and a call spread is only a time triggered settlement. And if you want to get out of the trade, you would you'd have to exit it early, which is that rule: alert, 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 alert. I gave this to you at binary options. It's true for knockouts and call spreads. Just because there's an expiration associated with the contract does not mean you need to wait until then. You can buy a knockout or a call spread, and you can exit early to lock in a profit. You buy them, it goes higher. You could take a partial profit, just a profit, and get out. If you could buy it, it goes lower. You can liquidate and take a partial loss. You do not have to wait. If you sold one and it goes up, you can buy it back and experience partial loss. You sold when it goes down, you could buy it back at a lower price and experience partial profit. You do not have to wait. Now, a knockout gives you those guardrails around it. If you're not paying attention, it does have guardrails to knock you out. And a call spread, you would not get knocked out, and you'd have to monitor your position and exit or liquidate when you felt appropriate, or it will settle with a time triggered settlement. I like to put this up before I jump over to the platform. I like to pop this up periodically throughout the day. I want to remind everyone, we do have this super cool Refer a Friend program at Nadex. If you're not taking advantage of it and you've got an account at Nadex, you might want to. And if you don't have an account at Nadex, right now, if you don't have a demo account, I would highly recommend you just simply open a demo account. It doesn't cost anything, and you can practice with these products, and you can practice trading. And get comfortable with the platform and how the products work and move. But when you do open a live account, all right, I would recommend that you invite your friends. There's no reason why you wouldn't, because if they open an account and place 5 trades within the first 30 days, we'll give you each $100. And if you do that with 10 friends, you can get $1,000 to play with at Nadex. That's not something to shake a stick at. Okay. With that, I want to go over to the platform, and I do want to show you knockouts and call spreads on the platform. Again, I'm not doing a deep dive into the platform. I know there's some recordings in the archive. I think I recorded one recently, and you can certainly listen to a full-blown analysis of all the functionality and tools on our platform. I know that my colleague Adam McCaden is going to be doing one in a couple of weeks. You can certainly register for that. All right, so let me now bring up the Nadex platform. All right, and we are going to look at knockouts and call spreads. All right, so in the upper left-hand corner, again, we've got our products: binary options, call spreads, knockouts. Oh, look, I'm on gold. Let's just do that. We're on gold knockouts, and I'm just going, and I click any one of them. It doesn't really matter. And the reason I say it doesn't matter is when I hide this, all right, we are looking at a chart of gold. And I'm going to do this a little bit. Notice on the left-hand side, I've got 4 vertical lines. They're blue. Those represent the different knockout contracts. So if I click on any one of these, it gives me the floor and the ceiling for that knockout. We make it very easy for you to choose and see which knockout you might want. If I were looking to sell gold and take a short price on gold, I might want to choose the one with the lowest ceiling. That would be this one. I can clearly see the ceiling here is at 1742. All right, these are knockouts. And if I wanted to sell it, I would simply click sell. And if I were to sell one with gold right here, it's a Delta 1 product. Trading around 17.28 an ounce. All right, and remember, this is a demo environment, by the way. I just want to call that out. You could see demo in the upper right-hand corner. But if I were to sell this, and let's just put 1730 in here, a nice round number. If I were to sell one of these at 1730 and it went up to 1742, all right, up $12 an ounce, I would get knocked out. I'd experience $120 maximum loss. If I were to sell one and it went down to 1692 and touched the floor, I would experience maximum potential profit of $380. All right, this is a knockout. All right, and remember, if I sold one here, let's just place an order for 1730. Now it's ticking a little bit lower. Again, if I sold it and it were to start going higher, I could always choose to buy it back before 1742 and just take a partial loss. If I sold it and it were to go lower, I could always buy it down here and take a partial profit. I don't have to wait for it to get down to 1692 for me to get knocked out of my trade. Now, if I were looking to buy a knockout, I might choose one with if I were buying, I might want the one with the highest floor. All right, now if I clicked buy, it calculates, let's just put in 1729. Let's just say I wanted to buy one below. So 1729. If I were to buy one just below at 1729, and it were to go down to 1722, it's only down $7 an ounce. If I bought it and it were to touch 1722, I'd get knocked out. I would lose $70. If it were to go higher up to 1772, I would get knocked out for maximum potential profit of 430. And remember, my capital requirements, whether I'm buying or selling, is the most I stand to lose. So I could go long gold here, and it would only cost me $70. Now, if it were to touch 1722, I'd get knocked out. I lose my $70. But if it were to trade higher, I would potentially profit on this trade. Okay, and this is why we give you different knockout levels, is you can choose the risk reward profile that suits your trade, suits your opinion. How much are you willing to put up as capital, which is always the maximum amount of risk that you've got. And what are you looking to do? What are you looking to accomplish? Do I think gold's going higher or lower? This is how you would do a purely directional play on the price of gold, because I'm trading the price of the underlying. If it goes up, I buy it. If I think it's going down, I sell it, and it's a Delta 1 product. Now let's take a look at gold. Just for fun, I'm going to do gold call spreads. All right, so let's click on call spreads. I'm going to go to commodities. Let's just look. Let's refresh this. Okay, so right, because it's this is because gold already settled at 130, which is 1230 central. So let's take a look instead at oil. We obviously need to list. I'm doing this a little later in the day, so let's take a look at oil on the call spreads. Okay, now with a call spread, if I click on a call spread, let's zoom this in a bit. Whenever I click on a call spread, you can see the range of that call spread. It's highlighted in blue. So if I thought oil were going higher here, let's just do this a little bit. Let's make this a smaller chart. Okay, there we go. If I thought oil were going higher, and hit this, and you can tell which one I'm clicking on because it's highlighted. If I were to buy this call spread, all right, it's got a floor of 65, right? And we are just below that right now. We're at 64.87. Realize this expires in 41 minutes. If I thought oil were going to pop and go higher in the next 41 minutes, I could buy this it would only cost me $8. And if oil happened to pop and get up to $70 a barrel in the next 40 minutes, I can make a pretty substantial profit. But if I thought oil were going lower, I would choose probably a different one. Now, if I'm selling, it gives me the range. If I were to sell, and here the ceiling is 65, all right? So you can see the ceiling is 65, it's in the contract. Our call spreads give you that range. It's highlighted. It's blue if I'm trying to buy. It's red if I'm trying to sell. We calculate your maximum potential profit or loss. There's a little bit of a premium in here, and realize this settles in 40 minutes. And with no volatility, these are trading pretty close to the price of the underlying. The underlying currently 64.86. The price to sell this is 64.80 is the mid market. But you would just buy it if you thought it were going up. You'd sell if you think it were going down. Now, again, if it touches the floor ceiling, you are not knocked out. You have time to be right. And that is the difference between call spreads and knockouts. All right. We've got 10 minutes to the top of the hour. Hopefully you understand the basics of knockouts and call spreads. It is another way to take a directional play on Nadex products. Unlike binary options, which are a probability with a total notional value of 100, call spreads and knockouts have a little bit wider ranges. The capital requirements are the most that you could potentially lose. Both of them have a floor and a ceiling, but with knockouts, you are knocked out of the trade if it touches the floor or ceiling. Call spreads, there's a premium baked into it, but you're not knocked out. You have time for it to be right and for it to move in your favor. And ultimately, your profit or loss is the difference between where you bought or sold it and where it settles, or with a knockout, where you get knocked out if it touches one of the boundaries. Okay. With that, we are going to take a 9-minute break. Let me change this up here to go back through our housekeeping items. Here we go. As a reminder, this is being recorded. Yes, it's being recorded. As a reminder, you'll be able to find the recordings on the Nadex website. And if you would like any of these slide decks, you'll need to request them from customer service@nadex.com.